We've borrowed from our whole life insurance policy to pay off credit card debt, buy a car, invest in real estate, pay for vacations, and pay for our utility bills. Sound crazy? It's not. My name is Carmen.
And I'm Darius. And we have 6 life insurance policies, and we use the same strategy to teach our clients all over the United States how to do the exact same thing by financing their own lifestyle using cash value life insurance. But the key word in this conversation is cash value whole life insurance. What exactly is cash value?
So the idea behind cash value is it is a cash accumulation that is available inside permanent life insurance products. I realize I just gave you a mouthful there, so let's break that down. When we think about life insurance, for Darius and I, we particularly talk about whole life insurance, meaning life insurance that is going to cover you for your entire life, hence why I said permanent life insurance before. So when we think about permanent life insurance, every time you pay your premium, there is going to be an accumulation of cash, money that is going to grow inside that policy. How we like to look at it, just to simplify it, is every time you pay your premium or the fee for insurance, the life insurance company is going to give you a small portion of your death benefit while you're living. They're going to allow you to access those funds, which is also called a living benefit, meaning something that you can utilize while you're living. Because so many people think that life insurance is just this thing that you put on a shelf and you have to die and you don't get to touch it at all. And the only people that benefit from life insurance are your heirs. So that's why it's important for you to understand what living benefits are available to you, especially with regards to permanent life insurance products, because you can utilize your life insurance while you're living.
Right now, when it comes to cash value, there's 2 ways that you can access these funds. The first way is a withdrawal, which a lot of us may be familiar with it, like when it comes to surrender value, things of that nature. So withdrawal basically allows you to take the money out, withdraw the money out of your whole life insurance policy. Basically like going to the bank and you withdraw your money. That money has been reduced by the amount that you borrowed. That's the same thing that'll happen to your life insurance policy with the withdrawal. Now, the second way of accessing those funds is by borrowing. We like to use this specifically because it's much better for us because our money still continues to grow. Now, the way this works is you call the life insurance company and say, hey, I want to get a loan for $5,000 using my life insurance policy that you have on file, of course. Yeah. They say, hey, give me your routing number and your checking account number. We'll send it direct deposit. Nice. Now, what happens is they say, okay, I see that you have $500,000 of death benefit or face value available. What I'll do is I'll use that death benefit as collateral to give you this loan. So what that allows us to do is the fact that we got a loan, that means our money is still continuing to earn interest. Our money is continuing to grow. That's how we're able to do the things that we're doing, because we're not touching our funds. We're using our funds as collateral to borrow money from the insurance company.
And the thing to note is to go back and forth between withdrawal versus getting a loan. Like we said, withdrawal, that money is no longer there, and you are subjected to taxes when you take the money out of your whole life insurance policy. Whereas when you get a loan, that money is actually going to grow at a compounded rate. Your cash value inside your policy is going to grow at a compounded rate, and it's going to grow tax-free. So nothing can out-earn tax-free compounded interest, which is super valuable to Darius and myself.
Now, that's the secret sauce to compound interest, is the fact that you're not touching it.
Yes.
Compound interest doesn't work when you take the money out and you put it back, or if you disturb it by any way. So when we borrow money from our life insurance policy and our money is sitting there still continuing to earn interest, that's how it's able to compound, because we never touch it. That's key. We never touch our specific funds.
Absolutely. So the third point that we want to share with you is how much can you borrow? Now, this is going to be dependent on how the agent designed your specific policy, because we all have whole life insurance policies, but the design can be very specific. And for us, if you get a policy from Wealth Nation, for example, we typically tend to try to give our clients as much cash value as possible, as much as it makes sense, right? So if we use an example, let's call a split 60-40. We will try to give you 60% of cash value available and 40% in your death benefit. So let me break that down even further. If we're talking about a $10,000 annual premium, meaning how much that costs you for life insurance, $10,000 a year, we are going to put 60% or $6,000 towards cash value and $4,000 towards your death benefit. So how much can you borrow? You can borrow up to that 60% usually, which is going to allow you to have $6,000 available in cash value.
In the first year.
In the first year. Now, Carmen, why can't I borrow the whole thing? Because remember that 60-40 split, we have to buy you death benefit, because at the foundation of this whole process, you are buying life insurance. And immediately you're not going to be able to borrow 100% of the funds that you have paid for, but it gets better with time. So with life insurance, you do have to be in it for the long haul. Your cash value, again, is going to grow at that compounded rate. And every single year, there is more money available for you to borrow.
Right. Now, this is based on how we design policies based on your specific needs. In a traditional whole life insurance policy, there isn't any cash value that's available in the first 3 or 4 years. That's why a lot of people say, hey, you can't borrow from a life insurance policy in the first year. That's because of the design of the policy. Again, in a traditional policy, you have to wait a couple years before that cash value starts to accumulate, and it accumulates slowly because your contract is for 100 years or 120 years. What happens is you have to make sure that you tell your agent exactly what are you going to use the policy for, so they can make sure they design your needs in this specific contract. So when it comes to how much can you borrow, you can borrow whatever cash value is available in that policy. You can borrow a fifth of it. You can borrow half of it. It's up to you how much you borrow. As long as that money is available, you can borrow it.
And the thing that I wanted to point out, you were talking about just being able to utilize the cash value and the design, one who has cash value versus one that may not. The idea to compare it to is just like driving a Camry in a snowstorm. You know, some people may say you can't drive a Camry in a snowstorm, but you can drive one that has 4x4, that has all-wheel drive, right? So it's just that simple of understanding the features that are available to you for you to be able to utilize the products for your specific needs, right? So that's why I want to make sure that we're on the same page. It's not saying that one policy is better than the other. It's just whatever your specific needs are at the time that that policy was designed.
Right.
So if this is of interest to you and you want to get a policy designed with high cash value, then definitely click on the link below. We would love to serve you at the Wealth Nation.
Right. Now, the next question is, when can I borrow? When can you borrow a policy? I know we talked about it a little bit before in the other points, but when exactly can you borrow the money? If that money is available, you can borrow it. Depending on how your policy designed, if it's designed and it says, hey, you have cash value available in the first year, you can borrow that money in the very first year. If you pay your annual premium and 2 weeks later that cash value is available, you can borrow that money as soon as that money is available. You don't have to wait a whole year before you can borrow the money, especially if you can see the money is available.
Exactly. Specifically for brand new policies, we say once you pay your premium, then wait 30 days, that cash value will be available to you.
Now, if you have an existing whole life insurance policy and you've never heard the fact that there's cash value that accumulates that I can actually use, maybe you should give your agent or the life insurance company that you have your policy with a call and say, hey, do I have cash value available? What is the maximum loan that I can get from my life insurance policy? And they'll let you know. Another way is you can get something called an enforced illustration, where it tells you exactly how much cash value you have and how much cash value you'll have available in the next few years of this policy based on how the dividends are being paid.
Now, the next point is, how do I pay the money back? Now, how you pay the money back is simple. It's two things. You can either have another phone call where you call the 1-800 number at the life insurance company and you say, hey, I want to pay back $5,000. Here's my checking and routing number. Or, hey, I want to pay back $100 every single month. Can we do an automatic payment? And they'll withdraw from your account. It just depends on how you want to repay back the loan. It's very simple. Or you can do a lot of this online now with your online account. But the idea is you have to pay back the cash value, right? Nobody's ever going to tell you, no, don't ever worry about paying back the cash value. Yes, you need to pay back the cash value. One, because there is interest that is going to be charged every single year that your loan is outstanding. I don't think we've mentioned that interest piece of things, because you have to think about, if you get a loan from the bank is going to charge you interest, whether it be your credit cards, your car note, your mortgage. Every time you get a loan, there's going to be some interest. So the insurance company does charge you interest. In our scenario, for example, it is 4% simple interest that is charged on an annual basis, which is a lot different than the credit card interest you are charged or your mortgage interest, for example.
Right. Now, the credit cards that we had, we were paying, the payments were compounded on a daily rate, and we were charged every single month interest on that credit card.
Mm-hmm. So the idea is, when do I pay this back? You want to pay the loan back as quickly as you can because of the interest. Now, again, in our personal example, it took us probably about 4 years to pay back just the credit card debt that we accumulated. So it's not that we didn't pay back the loans. It's just it took us a little bit longer because we had a payment schedule in place for us to pay back the loans. So the idea is, anytime that you get a loan, you need to have a payment plan ready before you even request the money, because you don't want to get into trouble where that annual interest rate starts accumulating. In addition to the principal that you owe, it can start to get expensive like anything, right? So again, go into this knowing, why am I getting a loan? How am I going to pay this back responsibly? And what is my plan to recoup all of this money?
Yeah, being unorganized can come back to bite you in the butt.
Yes.
And if you want to learn how we use our whole life insurance policy to pay off our $120,000 worth of credit card debt, is here. But just real quick, basically what we did is we used our loans from the insurance company to buy back our third-party loans that we had with the bank. And instead of making the minimum payments to the bank, we started making that same minimum payments back to the insurance company. Now, this was way more interest than what we were being charged, which allowed us to keep the difference. Mm-hmm. You heard that? It allowed us to keep the difference and use those funds in the future for other things that we use the funds for, like buying a car, financing our business, going on vacation. The interest is key. Mm-hmm. We took a low interest
arbitrage.
Yeah, we took a low interest payment, which is simple interest, charging us 4% annually, to what was compounded on a daily rate at 20% interest that we were having to pay every single month. We took that same monthly payment and we paid back the insurance company. But even after the debt was paid, we continue to make those minimum payments back to ourselves so that we can have those funds. Now, the question is, how often can I borrow the funds? This goes back to how organized you are, because this is going to be a little bit of a curveball, but you don't have to pay the entire loan back before you can get another loan. That's because we were organized. We were able to do this. We were able to continue to pay the minimum payments that we were charged on our credit card. We continue to make those minimum payments. And then even before the loans were paid back, we got a car. Now we have two outstanding loans, but we're organized in a way that we understand what's the minimum payments that we have to pay, and we just paid that back separately to the insurance company while maintaining our premium payments.
Mm-hmm. Now, one thing that you were saying, we were organized. The other thing to note, that if you borrow from your whole life insurance policy, this isn't going to just solve your financial needs.
No.
You have to be organized. You have to be disciplined, because the best part, and also maybe the worst part for some people, is that the insurance company doesn't send you a payment schedule. They're not going to call you and go, where's the money? I'm going to foreclose on you. That they don't treat this situation like the bank. Why? Because they already have your collateral, right? Mm-hmm. Which is your death benefit. So you have to be structured in saying, hey, if I'm going to get a loan for $5,000 or $500,000, I need to be able to have a payment plan or some sort of payment schedule in place so that I know that I'm going to pay all of this money back. Because the idea is, when you pay all this money back, you have it available to use again. Mm-hmm. So that's why you want to be good to your own banking system. And make sure that you have the funds available to be responsible.
Right. Now, another thing that's really nice about this is when we use it for investments that we don't know when we get the money back, we're able to keep that loan outstanding until those funds come back. From like a real estate deal that we did that took about 6 months. We didn't make any payments back to the insurance company for more than 6 months, and they didn't call us looking for the payment. But as soon as that money came in, we paid the loan back, and the difference, which we earned in interest, we were able to keep.
Yeah.
So we help our clients with being organized and understanding how they're going to make these payments back to themselves, depending on if they're paying off credit card debt, if they're buying a car, if they want to pay off their mortgage, if they're investing in real estate, whatever it is, we help you understand how to organize it, because that is another key to borrowing from your life insurance policy responsibly.
Absolutely. So if you want to check out our latest video where we show you how we bought our vacation through our whole life insurance policy, definitely check out the next video.
Remember to own your own lifestyle,
or someone else will.